I'll start off with Larry Katzenstein's pre-discussion here on charitable gift annuities, and then we can talk about it for a minute.
I'm Larry Katzenstein, and I'm looking forward to seeing you all at the Notre Dame program in South Bend. I'm going to be talking about something that I don't think estate planners think about enough, which is charitable gift annuities. I think a lot of estate planners know everything there is to know about charitable remainder trusts because maybe they're in the Internal Revenue Code and gift annuities are not a creature of the code. Also, there's not much to draft for a CGA. You know, the charities typically provide the document, which is often just one page. But there are so many things that you can do with a gift annuity that you can't do with any other technique. Gift annuities are actually a very old technique, and I'll just show you a picture here on my screen. This is one of the oldest gift annuities. This is the famous painting by John Trumbull of the signing of the Declaration of Independence. And when he was very elderly in the mid-19th century and kind of out of funds, destitute really, he gave all his paintings to Yale University in exchange for an annuity of $1,000 a year. So you can think of that as one of the first documented modern American gift annuities. So that's what I'm going to be talking about. And just some examples of some of the things that we'll talk about. The payments from a gift annuity are usually better from an income tax standpoint than the payments from a charitable remainder trust because you're not subject to the tier system. With every payment, you're getting back part of your investment in the contract. The self-dealing rules don't apply. Gift annuities are issued by public charities. So I can do all sorts of things that I couldn't do otherwise. For example, I can give stock of a closely held corporation to a charity in exchange for a gift annuity. And then I can have family members later buy it back for a fair market value. That's not a self-dealing transaction. You can fund tangible personal property with it to a gift annuity. And that would result in a full fair market value deduction for the value of the remainder. You can't do that with the remainder trust because it's not a related use for the charity. So I think you'll find this program helpful. So many things you can do with the gift annuity you can't otherwise do. You can have deferred annuities. You can have annuities where the deferral period is for a certain period, and then the donor can decide when he wants to start the annuity period running. So there's so many helpful things you can do with them. And like I say, most estate planners don't know much about them. So I look forward to seeing you there, and I think you'll find this presentation useful. Thank you.
Thanks to Larry.
Let me make a comment here. When you transfer an asset or cash to a charity, they're giving you a deferred payment obligation, which is nothing more than an annuity that's going to be payable for the rest of your life. You also get a charitable income tax deduction because about 70 to 80% of the value that you contribute is in the form of the annuity, and the remainder portion is an immediate charitable income tax deduction. But here's the key. If I have marketable securities that I intend to sell, and I would like to sell them, but I don't want to report all the gain up front, and I would like to report the gain piecemeal in the future, you basically sell the marketable security to the charity, you realize a gain, and you don't have to report the gain that you realize until the annuity payments are received in the future. So if you're 70 years old, you basically, and you live to the age 90, you're going to receive annuity payments for the next 20 years, and each annuity payment that you receive in the future is going to, a portion of it is going to be the gain you realized when you sold the marketable security to the charity. It's a very creative way to defer the gain on the sale of any asset, but most importantly, marketable securities, which is the easiest thing to do. Okay.
Gift annuities are a very creative concept. Larry's right. I don't think most practitioners are really familiar with them. And a lot of people that practice don't only work in the $100 million transaction area. I haven't thought about gift annuities for large dollar transactions, but for a lot of moderate wealth clients, and that can be a fairly significant level of wealth, because the exemptions are so high. Gift annuities provide a very creative way to plan not only for tax deductions, but to meet personal goals of the clients. So if you have a client that is struggling with aging issues, putting a part or all of their annual base expenses, living expenses on autopilot, where they buy an annuity and it guarantees a certain payment to their checking account, and you have all their billing on auto pay, is a great way to protect an aging client that may not have a large family base. I've seen interesting things done with tangible property, as Larry mentioned, and we'll all occasionally run into clients that have a collectible item that's quite valuable, and this could be the perfect solution. So very interesting topic, and I think will add to the quiver that we all carry of planning ideas.